Welcome back to the 60/40 cash flow series. Are you finding now that you're focusing a little bit more on the cash flow in your business? Because that's the key, to have more cash today than you did yesterday. And if that's not happening, we need to find a way to get your cash flow back on track. My name is Cherie, and this tip is as part of a series of 14 things that you can do to begin to take control of the cash flowing in and out of your business. And this is just the start. Over the past 15 years working with my accounting firm clients, I've helped hundreds of small business owners to work less, earn more, and to create a business that supports the life that they want. Is that what you're looking for? Because these tips are just the start of how we can help you do the same. So tip number 11 is to look after your accounts payable. Accounts payable form part of your current liabilities, so these are amounts that you need to pay within the next 12 months. They are typically an unsecured type of debt unless you've signed a director's guarantee. Now, a director's guarantee or personal guarantee is a document signed by a director that guarantees the debt incurred by the company. What this means is that should the company fail to pay that debt, then the creditor can seek payment directly from the person who signed that document. Just as you can manage your cash flow through your cash cycle by pulling forward your debtors collection, you can do the same, but in reverse, by delaying payment to creditors. Don't do this though without their consent, and don't string people along. There are a number of ways that you can legitimately structure the timing of your accounts payable for any deferrals. So just a word of caution here, this is the other side of your debtors, or the people who owe you money. These are now the people who you owe money. So whatever you do, don't play games and don't promise things you have no intention of sticking to. Remember, you're dealing with people and likely other small businesses. You are likely someone else's creditor, so deal with them the way that you would want to be treated. Where a larger supplier is offering you extended terms, then you would consider any advantages that you have in taking them up. Same with the offer of any volume discounts for larger purchases, just as long as you have the capacity to store it. So on the money meter, this is a definite money out matter. The impact is high because managing of accounts payable can be stressful, especially if you're low on funds and getting lots of calls or contacts like emails. However, it doesn't need to be like that. When times are good and cash flow is healthy, you're in a good place to negotiate the terms and then look into really starting to manage your cash flow cycle, including building out reserves or cash buffers. The ease to implement is super low, which is great. This is just about having and keeping great lines of communication and clear methods for how you're going to manage the relationship. Know what you want from them and know what is expected of you, ideally in a written format. The usual ratio that you would use for accounts payable are accounts payable days or days payable outstanding. Basically, they're the same thing. What it indicates is the average time in days that a company takes to pay its bills and invoices to its trade creditors. This is useful when calculated on a quarterly or annual basis. While it might seem like a good thing to have a high number here because it shows that you have available cash for short-term investments, it might not be so good as well, as it indicates that there might be a few issues with cash flow and in being able to pay for your supplies. So a days payable outstanding or DPO of 20 means that on average, it takes a company 20 days to pay its suppliers. Remember, it is an average, so the normal qualifications on averages apply. Although not stated on this slide, we would generally use average cost of goods sold figure in our worksheet, and that's opening inventory plus cost of goods sold less closing inventory. If you choose to watch this ratio in your business, then just to make this figure even more precise, you could use average accounts payable as well. This is just to allow for any fluctuations and show a better calculation. Whatever way you choose to calculate it though, just make sure it's always done the same way, because then you can create a time series and your own internal benchmarks. So let's think on a few questions surrounding accounts payable. The first one is whether you even need to watch your days payable metrics. If you're a micro business, then you'll pretty much have a gut feel about what you have outstanding. There's no point creating metrics to measure something that's just not an essential part of your business. But if you do rely on a lot of creditors for your purchasing, then this will definitely be something that you want to put into your cash plan, as managing your days payable outstanding is something that will be a critical part of your cash conversion cycle. The second question is, what types of things could you do to improve your accounts payable systems? How do you receive your invoices now? Are they emailed? Are they physically received? Or are they mailed? How do you confirm that you received the goods? Who authorizes payment for the goods? If you aren't the person who does this, is there a separation between who marks the goods as received to the person who ordered it and then who pays it? because that's what we would call an internal control. This is just a few of the extra things you could think of around this topic. So now's for the YouTube extra content. The first point is to batch your payments by only paying on a set date. This just means picking one day a week, twice a month, or once a month where you designate time to pay the bills. This might sound really easy, but putting into practice can take a little discipline. Aside from the items that you need to pay for upon use, like fuel or minor amenities, with anything that's paid on account, then this should be paid for on a set day of the week or month. There are a couple of reasons for this. If you randomly pay stuff throughout the month, it means that you're always moving from task to task, and you might make a mistake or be rushed to check whether you've received all of the goods and that they were in a saleable or usable order. By batching all tasks, you can maximize your time as you're only thinking about doing that one thing at that one time. Also, if a vendor calls for payment, you can take down their details and confidently tell them that you process all of your payments on a day and that you'll include it at that point. But honesty is the best policy though, so if you don't have any intention of doing that, don't say that. You just might say that you'll review their invoice at that time. As an example, I process all of my accounts on a Thursday, and I have 3 hours put aside for wages, scanning and managing of all my receipts, updating forecasts, and actually paying out the accounts. Having that regular rhythm makes management of all of my accounts payables process a lot easier. The second point is to forecast cash outflows. This isn't just your accounts payable though, but all of your payments. Do you know typically how much you'd spend in any given month on all of your suppliers and the timings of those payments? If not, then this is a great exercise. We do this in our fixed expense review worksheet where we ask you to take a good look at all of the payments that you're paying out and then get you to start building a budget for getting them done. The last point is supplier management. Can your supplier help you in managing your own cash flow? Have you thought about contacting your suppliers to ask them about volume discounts for larger purchases? Or if you're doing a single large purchase, whether pricing could be more competitive? Or if you could help your own cash flow instead by doing lots of smaller purchases or paying by installments? But a word of caution, you definitely need to do a cost check on breaking down smaller purchase packages because you don't want long lead times or extra freight to end up costing you more overall. This is one area where we have a number of projects, simply because the costs of getting it wrong can be quite high, and having money tied up can be a risk as well. Single large purchases can be incredibly beneficial for regular purchases you would make anyway, especially with products that are consumables and have no spoilage. The other thing on suppliers is having written agreements in place. These are great confirmation of the terms just to ensure that there's no misunderstandings. Thanks for listening to this tip in our cash flow series. We've got more to come, so keep an eye out for them as they're released on our social channels, or sign up for our email list where you can get a fast pass to access these tips and more. So just head on over to our site at www.6040.io/cashflow and get your access today. So there's 14 tips in total in this series, and we'd love to have you back. Have an awesome day.